Good morning, everybody. My name is Mark Muller. I'm a Director of Sanlam Private Wealth in Mauritius. I'm speaking to you from Mauritius this morning, which has just come out of a fairly hard lockdown. So we're speaking to 9 different geographies this morning across Africa. So wherever you are in Africa, we're very pleased to welcome you to this the second webinar that we're having with our esteemed colleague, Phil Smeaton, who's our Chief Investment Officer in London. Phil is an Oxford graduate, and the last session that we had, we got such positive feedback, Phil, that we thought we'd invite you back. So welcome, and thank you very much for your time once again. Phil, we started last time with a quote. Let's not break that tradition. It was the best of times. It was the worst of times. Which one is it, Phil?
It's from Charles Dickens, isn't it? Yeah, testing my my English knowledge there. I think it's we'll get into that. But as far as the market's concerned, it's definitely the best of times. But the economy, well, that remains to be seen, I guess.
Phil, I'm going to hand over to you now, but I just wanted to do some housekeeping with our attendees. I see the numbers are ticking up. There is a Q&A section that we're going to have at the end. Phil's presentation is going to be about 20 minutes, and then we're going to open the floor up to questions. I will relay those to Phil as we go along. As we did last time, any questions that we don't get to during the broadcast, we will try and get back to everyone. Otherwise, you're welcome to email me or Phil, and we'll respond to you. So Phil, without any further ado, let me hand over to you, and we look forward to your views on where we are.
Okay, perfect. Hopefully everyone can see my screen that I'm sharing. Yeah, I've titled this, So It's All Gonna Be Okay. I guess it gets into your question, the best of times, the worst of times. When we look at what the stock market has done recently, we'll see that the equity markets worldwide, this represents global equity markets, have bounced back very, very strongly, pretty much to the highs that we were at. The US market has probably been a little bit stronger here. And I think this is a source of surprise for many people. You often hear investors talk about the easy money's being made. And for me, the easy money is the money that an investment professional who looks at the data and assesses the risk and reward can say, yes, that's a good investment to make. I'll make that. There's risk there, but I'm compensated for it in price. Where we are now is what I would call the hard money. It's not obvious whether markets would continue to go higher. They're a bit more fully valued. Some of the risks are still there. And of course, I think a lot of people are fearful of a pullback, and have been for some while, and have seen this market go up regardless. I'm just going to put things into the framework that we use. So we try and look at markets valued relative to sort of an earnings power. So taking out the cyclicality of earnings, taking out the peaks and the troughs. And what we saw back in January was that on this basis, prices were quite elevated. And then we saw markets come down as the COVID crisis evolved. Fantastic buying opportunity in March, where things were very, very cheap. Lots of people out there selling stocks, really good quality companies for no reason other than just general fear and panic, margin calls, liquidity problems. And then we started to see that bounce back. Now, the first part of the bounce back, very much justified, makes a lot of sense. This last phase is getting to the point where there's a bit of exuberance, I would say, in stock prices. And we need to try and understand, well, what does that mean for how we should react? Lots of discussions around our investment committee about how much risk should we take off, having put risk on back in March. In the end, we've moved to a neutral risk-taking stance, which balances the short-term risks of a second wave of COVID, the fact that earnings outlook is still pretty dire for a lot of companies, and this will be a long slog, I think. It balances those risks with, well, the longer-term risks of inflation and what happens when the amount of fiscal stimulus we've had, the amount of money printing that we've put in, what if that just keeps driving assets higher? So it is a bit of a balancing act there. And I want to talk a bit about inflation later on, because that's a question I've increasingly got from clients and from colleagues. The work that we use, we try and put a number on what might the stock market deliver over the next 3 years. So our general framework is a long-term investment framework where we think about a 15-year horizon. But when we start to look at tactical asset allocation, adjusting for the current market risks and opportunities, we just narrow that down a bit and look over the next 3 years. As I say, back in March, when we did this exercise, it produced returns of about 13% a year for the next 3 years. That's very attractive. Equities should give you about 8%, I would say, 7 to 8% in the long term. So being able to pick up 13 in March was quite nice. Where we are now, that number's come down to about 4.2%. What I say about that's quite precise, isn't it? What that means is the likely outcome for the next 3 years is lower levels of return. So returns about 4%, and then we could return that 8% a year scenario that equities give you over the long term. So you can still make money in equities, but that margin of safety is gone. That protection that you get from price being low and being compensated by low share prices has been eroded. In the fixed income market, these represent the credit spreads you get from taking fixed income, from taking credit risk. I think what surprised me the most here is not that the investment grade spreads have come back down and those bonds have recovered, but really the speed of recovery in the high yield space. I think this is definitely being influenced by the Federal Reserve and the ECB that are buying credit, that are buying corporate bonds. The Federal Reserve is actually buying high yield bonds. Some might say that that's against the Constitution and illegal. Whether that's the case or not, they're doing it. So we have to deal with what they're doing, not whether they should be doing it. And there are still, I would say, a lot of companies in this high yield space that are going to default, that are not going to be able to pay back all their debts. And this level of high yield spread, I don't think it fully compensates you for that. So I think there's a lot of risk in the high yield area. There's some return that you can get if you pick your bonds correctly. But I mean, definitely if you've got a passive instrument, I don't think those would be great at this point. It seems very foolish to passively invest in high yield. You've really got to be careful just because risk is mispriced there. So you have to get your company selection correct. Partly why the market's a little bit excited at the moment is we have seen economic data start to improve. So we know we're trying to reopen economies. This is showing up in the PMI numbers here, so the Purchasing Manager Indices. This is a survey that's done in every single country. They ask businesses what their current conditions are. A number above 50 represents good conditions, expansionary conditions. A number below 50 represents a contraction. So you can see that wall of red that we've got there, it's still pretty tough out there, but actually it's slightly less tough than it was last month. So that 36.7 average has moved up to 14.6. So, I mean, a very quick summary of the market backdrop there is that equity prices and high yield market, risk prices in general don't have that margin of safety. So not really compensating you for the risks that are out there. So we need to have a little bit more belief that we're going to have a smooth recovery, not necessarily a V-shaped recovery, but a swift recovery where there's not too many problems for companies. We are seeing some of that happen, but that's still an open question. Okay, I want to shift gears slightly now and really talk about inflation and its impact on markets and how you can potentially use equities to protect yourself from inflation in the long run. I mean, first of all, why is inflation potentially a problem? Here you can see the federal funds rate. So this is US interest rates back down at zero. So the cost of money is now zero for those who can access the Federal Reserve's discount window, etc. And that money is sort of seeping into the economy. Well, when I say seeping, it's more like a tidal wave, I guess. Here's the Federal Reserve's balance sheet. So the higher this goes, the more money they've created and conjured into existence. As they expand their balance sheet and they buy assets in the market, they create new money that they put out there and give to holders. And you can see that the 3 or 4 trillion that has been increased since this crisis started really dwarfs the QE that we had in the great financial crisis in 2009, and it's still going up. So there's, where is this going to stop? Nobody really knows. What we've really seen proven here is that the Federal Reserve cannot really unwind what it's done. So the small, in 2019, that line was declining slightly. That was when the Fed was withdrawing its stimulus from the market. It was pulling back, it was letting bonds roll off, but not reinvesting them, and it was shrinking the money supply. So it was deflating the money supply there. And eventually, that culminated in market stress that forced the Fed to reverse course. Basically, that first little blip higher in 2019 is then started to intervene into the repo market. And then since, so it's going to be very hard for the Fed if they can unwind this. The banking system, this shows the growth in loans that the banking system has extended. It's currently growing about 10% a year. So, and there's a huge contrast here with the response in this crisis to the response in 2009, 2010. You can see in 2009-10, this went negative. Banks stopped making loans. They called those loans in. They retrenched. They tried to repair their balance sheets. This time, they're saying to companies, it's okay, come to us. We'll give you the money. We'll give you a loan. We'll extend this. It's not a problem. And they're really extending in money. Now, when the banking system makes loans, it does a similar thing as when the Federal Reserve creates money. The banking system creates money as well. Roughly what this means is that the money supply in the US, the amount of US dollars or US dollars that can be used to buy stuff, is increasing by about 15% a year. That's a fairly large rate of increase of the money supply when we're actually producing less goods and we're producing less services. So, we really need production of goods and services to build up and accelerate for that not to move from monetary inflation into consumer price inflation. We really have to understand the difference between those two things. Lastly, here I've got the government deficits for both the UK and a longer chart for the US, which is the blue line. Interestingly, a negative number here means that they're spending more than they receive in taxes. That has to be financed somehow. It's usually financed by bonds, which are sold to the market. Currently, it's financed by bonds, which are effectively sold to the Federal Reserve. So this spending is just being monetized straight away. I mean, through a few intermediary people, but monetized nevertheless. We'd already decided in the US that we didn't need to be prudent fiscally. They'd already started to spend more money, and that deficit was widening in the good times. Okay, you can somehow expect that deficit to widen in bad times when GDP shrinks, when the government acts as an automatic stabilizer, but to be spending as if it's spending like crazy in the good times is definitely a concern. And this is where we start to get into, when does monetary inflation seep into consumer price inflation? And there's really been so many studies, so many economists have tried to tackle this problem, and they've all failed. And they always will fail because there's no answer to it other than the fact that it's a psychological one. The reason money has its purchasing power is because it lets you have a claim on goods and services in the economy. Okay, and how an economy works is everybody produces goods and services that people value, and you all put them in the pot. The more you put in the pot, the more you're entitled to take out of the pot. So you might put in whatever your job is, the services of a plumber, and you might take out of the pot the services of a hairdresser. When you put new money into the system and you just give that to people, that means that there are some people in the economy that don't put anything into the pot, but they're entitled to take stuff out of the pot. And if that happens in a small way, it sort of goes unnoticed and just ticks along in the sidelines. But when it starts to happen in a large way, meaningful way, and when people realize that it's never going to stop and it's just going to persist that way, they start to get nervous about, will I have the purchasing power of my money? Because these people that take goods and services out without adding goods and services in, they're really stealing your purchasing power. Anyone who has currency gets purchasing power stolen. by the first recipients of new money that's pushed into the system. And that's why, all of the economic data points that we have, production, industry output, the output gap, the unemployment rate, all of these things, people have tried to link them and come up with a magical formula that says this is when consumer prices will move higher. It happens on a sustained basis when people lose faith in the ability or the willingness of the owner of the currency, the US government, to really honor their debts there and not to sort of keep dipping into that pool of goods and services. Now, let's have a look at equity markets. I've got the Argentinian stock market here from 2013 to just shy of 2020. And inflation in Argentina over this time period, it starts off about 10%, and then it ratchets up to about 20%. So Argentina is a nice example of a country that's gone through some serious episode of inflation. It's done so recently. There are other examples. I could have picked Zimbabwe, I could have picked anywhere else, but this data was fairly easy to get a hold of. The black line there represents the consumer price index of Argentina. So it starts off at 100, just as I've rebased the stock market to 100 at the start there as well. So think of a basket of goods and services. At the start of this period, it costs you 100 to buy. At the end of this period, it costs you nearly 700 to buy. Equally, the stock market, if you buy the stock market at the start, it's worth 100. And if you sell at the end, it's worth about 700, 800 as well. So the investors in the stock market had their purchasing power preserved by investing in equities. Even though there was inflation and inflation went up rampantly, they preserved their purchasing power in Argentinian pesos. It's a pretty rocky ride, though. You can see there's some meaningful peaks and troughs there. I think in the early stage, it moves up to 230 or so, and then it pulls back to 130. So it's a pretty big drawdown. And if you were holding at that time, you'd probably be quite nervous. You'd probably be a little bit scared. Maybe you get shaken out. Of course, if you did so, that would be the worst thing to do. You would have ruined your plan. Your plan was to invest in equities to protect your purchasing power. You made some money and then you saw it disappear, and then you got scared out. So you've really got to stick with it in order for this to work. It works in the long run, but not so much in the short run. One of the things that we can do is often when we're looking at emerging market currencies where there's been significant inflation, we throw that return series into a hard currency. So here we've put it into US dollars, and you can see US dollars, you've sort of gone sideways. You've lost a little bit of purchasing power in US dollars. There's been good periods where the market's been really strong. There's been some quite large pullbacks. It's been a volatile ride, but it has preserved. You haven't lost too much in US dollars, and you've preserved your purchasing power in Argentinian pesos. Okay, let's look at developed market. So this is the US stock market and US consumer price index between 1960 to 1984. And the blue line here, which starts off pretty low, pretty benign, inflation just below 2%. So kind of what we've had recently, I would say. And then all of a sudden in 1964, 65, it starts to move higher and it hits 4% and then it hits 6% and it pulls back. Then it climbs up to 12%, pulls back again down to 6 and up to 14%. So a bit of a rocky ride in inflation numbers, struggling to get it under control, and it gets out of control. The black line there you can see is the stock market. Now, let's have a look at some periods here. So this very first period, you can see inflation surges, and actually, stock market does quite well. So the stock market rises. Again, it's got one of those vicious pullbacks there where it's fallen from about 150 to 130. So probably a 20-30% pullback there. But actually, the stock market's gone up as inflation has surged there. If we look at the next period where inflation surges, well, here the stock market doesn't do so well. It actually falls quite significantly from 200 to 100. So first time inflation went up, stock market went up. This time inflation went up, stock market halved. And if we look at the next period, inflation again surged from 6 to 14 there, but actually equities held in there, so they were pretty strong, and they started to move up. So what I'm trying to explain here is that equities will protect you from inflation, but there are periods where there are disconnects There are periods where they behave in ways that's slightly surprising. And it makes a really volatile investment backdrop for you to deal with. So, I mean, it's good news story, bad news story. So the good news is that, yes, if you're worried about inflation, you can protect yourself in the long run. But the bad news is the price that you pay for that is you have to suffer some quite meaningful volatility, and you need to be prepared for that. We can do the same thing. We can throw, just as we threw the Argentinian stock market in hard currency US dollars, we can throw the US stock market here into a hard currency, which in this case is gold. So if we think the US dollar is weak, then we need to go to the next best currency, which is gold. If we do that, I've jumped ahead slightly. This shows the actual CPI of the US, and you can see you are indeed preserving your purchasing power. But if we throw it into gold, you can see there are times when the stock market does well in gold, and then there's times when gold does well as well. So gold equally is not a panacea that solves all your problems. Again, the linkage between gold and inflation, consumer price inflation, there can be disconnects there as well. And I think my message here really is both of these asset classes will give you long-term protection from inflation. However, they are both volatile. They both might have drawdowns when viewed from the currency you're trying to protect yourself, but they're both tools in your toolkit. They behave differently. They do give you some diversification, so you can start to use the two together to help navigate that environment. Good news as well, currently inflation break-evens. So if we look at the bond market and inflation protected bonds in the UK or in the US, you can actually get insurance quite cheaply at the moment. So the level of inflation priced into these markets is for the UK, about 2.9%, which is roughly what the retail price index has been. That's what they key off. And in the US, it's actually even better. So it's only 1.1% is priced in, whereas their target is 2%. So insurance is like many things. When it's not obviously apparent in the numbers at the moment, such as the CPI numbers, you can get that insurance quite cheaply. If that inflation starts to move higher, you'll find that insurance becomes quite expensive and probably runs ahead of what it's likely to do. So when we're thinking about what asset classes do I need to be in to protect from inflation, it's not a simple answer of it's X, Y, and Z. It depends on the price as well. It depends what's priced in, and it depends what risks are there at the moment. Going back to what I said about equities at the start and how that margin of safety had been eroded somewhat. Unfortunately, that means that at the moment, equities as a hedge against inflation, if inflation were to pick up, the equities are fairly expensive, you just increase the chance that you might see a little bit of a sell-off at the start. So you have to sort of bear that in mind when you create your plan there. But just a summary here, and then hopefully we've got some interesting questions that we can go through. Most economists have wasted their lives trying to predict consumer price inflation. But the things that cause this as a risk, indeed, it might not happen, right? It might be the case that the economy starts to move again. We all get back to work, things turn to normal. Prices don't rise that materially. Maybe there's a little change and shuffle around, but it comes under control, and then the government backs off from its spending and lets the economy get back to work. It's definitely possible, and we can hope that that's the outcome, but it's not the only outcome. We need to be prepared for all sorts of outcomes. When government is spending and it's financed by the printing press, that is when your risk of inflation is higher. And when is it crystallized? It's crystallized when people realize that it will never stop. So if we get to the point where people think the Fed will never back off, the government will never stop spending, we'll just stimulate ourselves into the ground, that's when we run the risk of those inflation expectations becoming unanchored. Equities do protect wealth from inflation in the long run, but that volatility, those drawdowns, you have to be aware that they're part of the ride, and you need to keep a cool head and tolerate that volatility. And just on that last point, I think this is something investors often don't fully understand. People see investing as a way to make more money, way to make more currency. Well, currency isn't really worth anything. Nobody wants to have dollars. What they want to have is the purchasing power that comes with dollars. They want to have that claim on the goods and services produced by the economy. And really, real wealth is the ability to put goods and services into the pot so that you can take those out. And of course, there's the stock market, real businesses producing real goods and services, that is real wealth. So we shouldn't forget that. Doesn't matter what prices are doing. And so even when prices are falling and it seems like panic is in the street, you've got to remember that that is real wealth. And yeah, I'll stop there, Mark, and we can see what questions we've got.
Yeah, thanks.
I've been told.
Well, I wonder if you can pull that last slide up again, Phil, because there's a couple of questions that are coming through, and I think they relate to that last slide, number 18, the summary page. Yeah, I've got a couple of questions that have come through. Thanks very much for that, Phil. Very interesting. I'm going to start off with the first one and jump straight into it because I'm mindful that we've got about 10 minutes left. Herd stock, Boeing stock prices have risen seemingly completely not linked to what the reality is. You know, for instance, Hertz has, as you know, gone into bankruptcy. Boeing, I can't see there being much travel in the next while, yet the stock prices are rising. What is the rationale behind that? Is there a rationale?
Yeah, I think there's been some speculation that's seeped into the market by, I guess, investors who aren't really fully informed is the only way I can think of it. The Hertz is very interesting because that's a company that's actually filed for bankruptcy. And as an equity holder, you get nothing when a company is bankrupt. The reason it's gone that far is not even Chapter 11. I think it's proper bankruptcy. And so as an equity holder, you're going to get nothing, yet people are buying the stock anyway, and they clearly don't know that they're not going to get anything. It went so far as that I think the Hertz CEO asked the bankruptcy court for permission to kind of reopen up the company temporarily so that he could sell stock that they have into the market, get that money from the people buying the equity in order to pay off the bondholders and increase the recovery rate the bondholders would have. And I think I've never seen that before. That's definitely unusual. I think there's some speculation in there.
Phil, there's a couple of questions that are coming through. You spoke earlier about the V-shaped recovery. There's a question about W-shaped recovery. I'm going to read it. To you, surely third and fourth quarter global earnings and dividends will massively disappoint, leading to a major sell-off of equities and a W as opposed to a V for the remainder of 20 into 21. That's the question.
I think so. I think people have got a better handle on what earnings are going to do now, to be fair. I mean, what our analysts did as the crisis unfolded is every single stock that we own, we went back to basics and we said, okay, how is it going to impact their business? We readjusted all our forecasts and readjusted all our valuations so that we were in a position to make a sound decision about whether it was a reasonable thing to buy that company and whether the share price had overreacted or not. But it's, you know, Jerome Powell was even talking the other day about how it's going to be a slow recovery and the economy won't be back to the highs until 2022, I think he said. And that's back to the highs. It's not back to the growth path that we should have been on. It's back to where we were at before this happened. So it is going to be a long, drawn-out recovery. I don't think people misunderstand that. I think they understand that, but they've got swept away with this idea that you can't lose in the stock market because there's so much fiscal stimulus and there's so much money printing and there's so much Federal Reserve buying corporate bonds, and well, if the equities go down, they'll just buy equities, I think is the thought process. And I do think that's misguided. I don't think that gives you as much protection as people think. So, you know, lower prices gives you protection because that builds in a margin of safety. That margin of safety is not there anymore, and it's going to be a tough time for corporates for the next year, maybe 2 years.
So then to be a bit more granular, and the other question is, how would you advise clients? Clients are in equities. The last session that we had was sit it out. If you've got a good asset management team in place that can guide you through this process, what would your advice be to clients? As I said, we've got clients and counterparties sitting in 9 different geographies. Your advice to clients pursuant to that last question?
Yeah, I think you've got to have a plan for how you're going to deal with. So the market, the market always gives you, it offers a particular return. Sometimes that return is high, as it was back in March, and sometimes that return is lower, as it is now. And your decision that you make is, well, am I going to accept that return and be invested? And you need to have a process which is going to, you know, manage that decision for you. You need to decide, well, how often am I going to make that decision? And what's the basis I'm going to make it on? So the way we do it is, you know, we have a certain level of risk that we're going to take, and then we adjust that risk depending on our confidence and our skill. Because even a skilled manager is sometimes wrong. You could make the decision today. You could say, well, okay, the market is expensive, that margin of safety is gone, therefore I should take less risk. And that's, I think, a perfectly reasonable thing to come to. But the question becomes, well, how much less risk? Because if you just take everything off the table and you take zero risk or zero equity risk, then you're taking the risk that you're holding cash, and will cash retain its purchasing power? What if the market goes higher and just never comes back and you never get a chance to buy in? So you've got to balance that. Well, what if I'm wrong? And if I'm wrong, make sure it doesn't do damage to your long-term goal. So you have to understand your long-term goal, and then how much are you going to put that at risk by making shorter-term decisions. I think one thing that is worth doing is, if you were uncomfortable with the amount of risk that you were taking back in March, and you did the right thing and you stuck in there and you held through that, now is a good time to reassess that and make sure that you're taking the right level of risk. And if we were to have another, let's say, you know, a drawback of, I don't know, 10, 15%, you know, how comfortable would you be? Would you be able to, you know, hold through that again? So make sure you're taking the right level of risk to meet your long-term goals and that you're comfortable with. It's a good exercise to do now.
Phil, we don't have much time left, but I'm going to ask you two questions. One's come through on, there's a question that's come through on inflation hedges, which hopefully we get time to. But I want you to just read you a quote from Oxford Economics that said that US stocks are expensive and that there's an expectation that the market is vulnerable to a correction. What is your response to that?
Yeah, the US market is expensive. It often is, actually. It's often the more, if you look at it on a pure multiple basis, it's often the most expensive market around the world because it has some of the best businesses, frankly. You know, you don't find Google and Microsoft in many places around the world. They seem to be unusually concentrated in the US. I don't know if that's because they're better at fostering those businesses or not. Is it more vulnerable to a correction? Ordinarily, what happens when there's an equity correction is the US sees a bit of a flight to safety, and the US market tends to hold up a bit better. It's actually the more cyclical countries, like, you know, the Japanese equity market, the European equity market, that take it on the chin a little bit more. I think it depends on what sparks the correction. If the correction is general fear of you know, bad results for companies, and that causes a pullback, then I think the US market will hold up okay. If what sparks the correction is a weaker dollar and loss of faith of the dollar around the world, then I think the US market would then sell off more than the rest of the world. But, you know, that's a very difficult question to answer, which routes that would go. And clearly what the US is doing with its currency is, I think, testing a lot of countries' patience as to whether they should be holding it in such a large amount in their reserves. I mean, longer term, I don't know how much we've got, but longer term, emerging markets generally have given the US a real gift. Okay, they put all those goods and services into the pot, and they've allowed the US to just print currency, dip into the pot, and take those goods and services. And that's why, a big reason why the US is so wealthy. It's been, the rest of the world has been working for the US on the cheap. If that was to change and those countries were to say, well, why do I produce all this stuff and ship it to America? Why don't we just keep it at home, use it for our own citizens? That would see a revaluation of their currency's values, shake up of their domestic industries, where some companies would be losers and some would be winners. But you'd see in the long run their economies probably benefit a bit from that.
Phil, we do have a couple of minutes left. Next question. Please, can you tell us how to buy cheap inflation hedges? Are UK inflation-linked bonds good value?
They are good value in the sense that that risk is quite high. If you think that the world is going to be normal, and inflation's going to come in kind of what it always has done. And if you think inflation is going to come in at what their target is, then actually they're just as good value as conventional bonds. The bad news is conventional bonds aren't very good value. So if you're comparing them versus that, inflation-linked bonds, I think, are a lot more attractive, because you get that inflation protection, but without having to pay anything really.
Phil, we're going to end off. Is there perhaps, as I said to you, we've got counterparties who have tuned in as well. In advising their clients, what would be your advice to them, clients sitting in various parts of the world? What is, in a nutshell, what would you be telling advisors at the moment and clients?
I think you've got to focus on what your long-term plan is going to be, and make sure that you're diversified in the right ways, not just with the right numbers of stocks in different industries and different countries, but also diversified with respect to, do I own companies that produce real goods and services or of value that are likely to be able to retain their purchasing power and deal with any inflation that comes along, and also stay in companies that still have solid balance sheets. Okay, you don't want to go into, as tempting as it is to pick some bankrupt company like Hertz and say, well, it might pop and go from $2 to $8 and I could make a lot of money. The risk that you take as a long-term holder of financially geared businesses is still real, and I think still something to avoid. So keep gearing low.
Phil, thank you very much for your time. We're not going to have much more opportunity to answer the questions. As I said, if to the questions that we haven't got to, we'll try and email and get back to you where I do have your contact details. Otherwise, you're welcome to email me, and I can flick those questions on directly to Phil if so required. But Phil, thanks very much for your time once again. I think we'll do these quite regularly because I think they've proved to be quite insightful. So from us here in Mauritius, from Sanlam Private Wealth, thank you very much for tuning in, and we hope to see you in our next session. Thanks again, Phil. Much appreciated.
Thanks for having me, Mark.